So in this section, we're going to be discussing financing your new home. If you look here at the first slide, we're going to talk about a couple items out of the many that you'll need in obtaining a mortgage. And it'll also have a little bit longer, but still just an abbreviated list on the first page there of your packet. The first thing is you're going to need most recent pay stubs, 2 to 3, W-2s for the last couple years, 2 to 3 years, federal tax returns for the last 2 to 3 years, your last 2 to 3 months of bank statements, any long-term debt like student loans, car loans, credit card loans. Your lender's going to need a lot of information, and throughout the process, you're going to give them some information. Let's say, for example, you give them a bank statement. They'll look at the bank statement. There might be something in that bank statement that's going to require them to see another piece of paper. And then that paper could cause them to need to see another document. So it's a really ongoing process. It is a lot of paperwork, but the best way you can prepare yourself is to just start early and get it to them. The quicker, the better. And your professional lender is going to be able to help guide you through that process. But right here is if you want to start getting this stuff together that you can see in your handbook, it's a little bit longer list than what's on the slide. That'll just be even better for you getting your ducks in a row. So how much home can you afford? Your lender's going to help pre-qualify or pre-approve you. And what they're doing is they're essentially establishing how much you can afford, and that's all based off of your debt to your income, and they do a ratio. So the less debt you have and the more income you have, the more house you're going to be able to buy. There's a lot of different factors that ultimately play into it, including your credit score, and your lender would be able to specify and tell you specific to your situation a little bit more information about that. This is going to be just a general overview, but a pre-approval typically is better than a pre-qualification. Some lenders use pre-qualification, meaning pre-approval, but essentially when I refer to a pre-qualification is you could just call anybody out of the yellow pages and say, I make $100,000 and I only have a $300 car payment. And they'll type it in their computer and they'll be like, oh, well, you can afford up to a $300,000 house. There's no real validity to that. They may give you a letter saying you're pre-qualified up to that amount, X, whatever it may be, the number they came up with. But in reality, that's not a lot of real strength or proof when you go to actually write a contract for a house to submit with that. When you submit a contract to a seller, 99.9% of the time, they're going to require a pre-qualification or pre-approval letter up front. And the stronger your letter, the better you're going to look. Because if you come up multiple offers and you are fully pre-approved and the other person doesn't have a lender letter yet, they're not even going to consider that one. And I want my clients to be in the best position possible to help you get the house that you like, that suits your needs, at the same time get the best deal possible for you too. As part of the pre-approval process, that's where they're going to check your credit. And when you go through the get a real pre-approval, that's where they're going to actually collect some data up front. And a couple things to remember, essentially from when you decide, all right, let's buy a home, to when you close, you want to keep your credit as stable as possible. So in doing so, it's really important, it's super important from after you go under contract to closing, not to change your credit score. And how would you do that? Well, I would recommend not financing anything big, like a hot rod, big screen TVs, furniture, any appliances. The story I've heard is a couple days before closing, the buyers are really excited. They're like, well, we need a washer and dryer. They went to their local Home Depot, Lowe's store, and they saw a washer dryer they liked, and they ended up putting it. They opened up a Lowe's credit card to buy it, had it set to deliver a couple days after closing. Well, since they did that, that changed their credit score. And I don't know whether it screwed up the closing completely or if it just threw a wrench and delayed closing. It's not something I want to see my clients have that happen to them. Most of the time, the lenders will pull a soft credit check the day before closing to make sure you haven't gone out and bought 3 or 4 cars, because that would really make a difference to them. when moving forward and buying a home and them giving a loan for it. So if you look at the handbook here, the next page, you can see the steps in getting a loan. The first part we already covered, organize your documents, getting qualified. And then once you actually have a property under contract, that's where you really want to lock into the specific type of loan. And then that's when you're actually able to lock into your rates. But shopping the different loan programs, discussing with your lender ahead of time is definitely a good way to just be getting your ducks in a row so you'll know moving forward when you find your house which route you're going to go. And then after you have your property under contract, that's when you actually go in and you apply for the formal loan application. And contractually, the way our contracts are written now, you have 7 days to go in and do the full loan app, sign all the docs, get the money to them that they need to process that. So please keep that in mind. I'll be reminding you, of course, of a lot of this stuff through the process. Then 30, 45 days later, depending on the loan, you'll get loan approval, and then we're good to close. A lot of specifics and all of that you can find over the next 3 pages in your buyer's manual here. So please review that, and when we meet, I'll be more than happy to answer any questions you may have about that. So what kind of loans are there? Well, there's 5 main different categories. The first one being conventional loans. Then you have FHA loans, VHDA loans, VA, and rural USDA. So a conventional loan, they're loans that's been around for a long time. You hear them normally, conventionally from the big banks. They're going to have a little bit higher of a down payment. There are some that advertise 3%, but typically you're going to be seeing a minimum of 5%. And they usually go up in about 5. So you have 5% down, 10% down, 15% down, 20% down. The benefit in going conventional is once you get to that 20% down, you don't have homeowners mortgage insurance on your loan anymore. It's sometimes referred to as MI or PMI, and that's awesome. But anytime you're under 20%, you're going to have some sort of mortgage insurance, and the more you put down, the less that's going to be. And there's a couple different ways you can play with mortgage insurance. You can pay for it up front, you can pay for it monthly, you can pay for it up front, but then finance it into your loan. So that's why talking in detail with your lender, they'll be able to look at your information and help figure out what would be the best route for you, depending on how much you're going to buy, how much you're going to put down. FHA is the next main type of loan. Those are one of the most common loans right now. It's a government-backed loan, and they allow you to get into a house for only 3.5% down. The benefit with that, other than you needing a little bit less money, is they're a little bit easier, not a lot, but a tiny bit easier on qualifying with credit score. They're a little bit easier to qualify depending on your debt to income ratio. A little more lenient on helping with your down payment funds as being a gift from a relative, family member, friend, etc. And a little bit better on seller contribution to help you to get that loan. So the FHA is a great product. It helps a lot of people get into homes that otherwise wouldn't. And then when you look to the next one, the VHDA, that's a Virginia housing specific loan for first-time home buyers. They have a VHDA Plus loan where you can actually get into a home 100% financed. So I know I'm skipping ahead a little, but let's say your seller helps you out with some seller paid closing cost, and you go the VHDA Plus 100% financing route. Essentially, you can get into a house for just the cost of the appraisal and the home inspection, fairly cheaply. I've helped a lot of friends personally get into a house for not a lot of money up front, and now they're paying less than they would be renting and they're owning, building equity. The next type of loan is VA. That's for veterans only. So if you've served in the military, you can qualify for a VA loan. Benefit in that is that they have 100% financing. And there's a couple other nice things. There's a couple different VA loans. So depending on your lender, I would talk to them to see exactly what benefits you would get other than just that 100% financing. And another note, not all lenders have the same type of loans. Not all lenders are able to sell the same types of loans. So that's why uh, I always like recommending correspondent lenders. They're able to get you a wider variety of different types of loans, and then they can shop those loans for you and help you get the best deal possible. The last type of loan is the rural USDA loan. This only qualifies specific zip codes, a little bit out closer to the country. It's a lot different to process. So anytime I have a client looking at those, I actually have a specific lender that only does rural USDA loans. So what exactly is mortgage insurance? Well, mortgage insurance is a tool that helps home buyers buy a home with less than 20% down. Depending on the type of loan that you end up getting, you can have that mortgage insurance removed from your monthly payment when you reach a certain amount of equity. It's typically around 20%, but again, every loan's different. Talk with your lender. If you're looking at a specific loan, ask them at what point can I get this mortgage insurance dropped off and how do I do it? So interest rates, they are very interesting. They change multiple times a day, just like the stock market. They change on a variety of reasons, mostly financial and economic factors. On average, though, you're going to see as the economy does better, as the housing market's doing better, you're going to see interest rates start to creep back up. The reason they were so low and still are near historic lows are because the economy and the housing market's done so poorly over the last couple of years. As things start to do better, we will start to see higher interest rates. And higher interest rates just means you're either going to pay more for the same house or you're actually going to be able to qualify for a little bit less house. So closing cost on the buyer side usually runs about 3% of the purchase price. I have broken down here on the slide the different areas that the cost can be broken up into. And the ones in red are the ones that you actually pay before closing. Everything else you pay at closing. But if you average it all together, it's going to be really close to 3%. You have your lender associated fees, which include the appraisal and your credit report. And then if you have any points or origination fees, and then the underwriting admin, doc prep, that a lot of times that can be charged as a one-time fee, or that would be considered part of your origination fee. And what that is just money to pay the people who work at the bank between the lender, all the underwriters, the processors, the closers. There's a lot of people there who help you get this loan, and a lot of that goes toward them. For the appraisal and the credit report, once you are under contract with a property, they're going to ask for that up front. So typically you write them a check, and that way they can pay to send out that third-party independent appraiser to get that part processed. Then you have all your attorney or settlement fees, all your closing fees, courier fees, doc prep fees, your title insurance, and we'll get into that a little bit later in detail in the home purchasing part of the video. Your recording fees to record it into the city or county courthouse. And then you have your escrows. You'll prepay, depending on the county, 3, 6, or even 12 months of your property taxes. You'll prepay 6 or 12 months of your homeowner's insurance, depending on your homeowner and your lender, what they'll require. And then you have your miscellaneous, your survey. Right now, that's optional. They run about $300 for the average residential home. Of course, those are based off of acreage. So if you're buying a big property, big acreage, or a farm, it's going to be a lot more than that. But on average, I usually see them around $300. And then home inspections, again, based all on size, based on square footage. So the bigger the home, the more it's going to be. If I had to estimate it, you're probably going to spend about 3 to 350. Every homeowner or home inspector is a little different in what they charge, but just to get an idea, it's going to be right around that price. So that concludes the financing and qualifications part of the video series. The next part I'm going to jump into is real estate agency and the Coldwell Banker Advantage.